Okay, so now let's talk about dividends. Now, we are specifically only going to talk about cash dividends in this course. There is such a thing as stock dividends. I'm not covering them in the course, although they are covered in your textbook, and you're welcome to read about them and learn about those. I'm also not covering stock splits, although you are welcome to read about those in your textbook as well. All I'll say about that is stock dividends and stock splits are not the same thing, okay? So we're only going to be talking about cash dividends here. Now, how do dividends work? So dividends can be paid in the form of cash, stock. You can even pay asset dividends. Again, we're just going to pay cash dividends. Those are the most common type of dividends that are paid. Any profitable corporation can choose to share this profit with their owners. So instead of giving our owners paychecks, we may just say, hey, we had a really good year. I'm going to share this with the owners through dividends. Now remember, corporations are not required to pay dividends. Only the board of directors can make that call. There are companies that pay dividends and pay dividends every year. Disney's one of those corporations, so every year I get that dividend check. There are a lot of companies that do not pay dividends. There are a lot of companies who feel that it's a better use of the money to reinvest those funds and come up with a better product that's going to increase the stock price more. I can certainly understand that logic. Again, I told you typically Disney's dividends are around 80 cents a share. I don't own a whole lot of shares, so that 80 cents a share isn't really providing me with a lot of income. I usually get about enough that I could order a pizza with. So I personally would rather Disney just keep the 80 cents and then, like make me a better movie, right? Give me another Hamilton on film or something like that. Make a better product. Give me a new ride at Disney World that's going to bring in more money than the 80 cents a share that you're going to give me. So that's the feeling. How you feel about dividends is up to you personally. Some investors want dividends, some investors don't, and some investors really don't care. So it just depends. So there are three dates in the life of a dividend. The first date is the date of declaration. So remember, the board of directors are the only people who can declare dividends. So the board of directors are having a meeting. Typically, they're going to be going over the financial statements and they'll be like, oh, we did pretty good here. Let's pay a dividend. And so they go through, if you are familiar with parliamentary procedure, Robert's Rules of Order, someone makes a motion. I motion that we pay a dividend of $50 million or however much they want to pay. Somebody seconds it. They have a vote. If they vote yes, that they're going to pay this dividend, then that is the date that the dividend becomes a legally binding obligation. In other words, that is the date that the liability is created. So typically the way this works, they'll come out of the board meeting, they'll hold a press conference, and they'll say, by the way, we declared a dividend of $50 million or whatever it is. So that gets announced to all of the shareholders. So this is the day you voted on it, you've declared it, you've announced it. It is a legally binding obligation. Now, they're not saying they're going to pay the dividend today. What they say is, for example, if they're recording this, they're going to say, we declared a dividend of $50 million or however much it is to shareholders of record as of some date about 2 weeks from now. So I'm recording this on July 6th. So they're going to say, we on July 6th declare this dividend to shareholders of record as of July 24th, payable to shareholders of record on August 6th. Okay, so they're giving you two more dates. One is the date the actual payment's going to be made. In our example, I believe I said that was August 6th. And one is the date of what we call the date of record, and I believe I said that was July 24. So today, the date of declaration is July 6th. So what's going to happen is they're telling everybody, if you want to receive the dividend, then you need to own the stock at close of market on the date of record, in our case, July 24. So that means between now and July 24th, everybody who wants to own this stock who wants to receive the dividend is going to start trying to buy the stock. So the stock price is going to shoot up, okay? And usually it's like a 2 to 3 week window. The stock price is going to shoot up. We know it's going to shoot up. We're not surprised it's going to shoot up because all of us who want the dividends are going to start buying the stock. Those of us who don't care about the dividend are going to sell the stock when the price gets real high, right? So I'm just making up numbers here, but let's say that on July 6th, the stock price is $100. Okay. Maybe by close of business on July 24th, the stock price is up to, I don't know, again, I'm making numbers up here, $180. It shot way high. Okay. So the date of record is just the date that we're going to make the list of everybody that owns the stock, how many shares they own, and what's their address so we know what address to send the check to. So what's going to happen is on July 25th, when the market opens, and we know this is going to happen, we're not surprised or shocked when it happens, but on July 25th, when the market opens, the stock price is going to plummet because I don't have to own the stock anymore. I'm going to get the dividend. I own the stock at close of market on the 24th, so I'm guaranteed to get the dividend. So the stock price is going to plummet. I don't know. Let's say it drops down to $70 a share. Now the stock price is plummeted. People are going to start buying it. It's going to come back up and level out about it's $100 a share, okay, or whatever its kind of normal place is. But we're not surprised about this. It doesn't make the news. We all knew it was coming. So the payment date usually comes a couple of days after, or a couple of weeks, pardon me, after the date of record. This gives the company time to get all the checks printed for the right amounts and addressed and mailed out. So August 6th would be the date that the checks are mailed out to the shareholders. So we need to go through and know the journal entries for each of these 3 dates. So on our example, we're told on May 1st, Smart Touch Learning is declaring a 5-cent per share cash dividend to 22,700 outstanding shares of common stock. One point I want to make, we do not pay dividends for treasury stock. So any treasury stock that we own, we don't pay dividends for that. So on the date of declaration, this is the date that the dividend becomes a legally binding obligation. Remember, this is the date that the liability is declared. So on this date, we will debit the account dividends or cash dividends, and we will credit dividends payable. Dividends payable is a liability. We've created the liability. This dividends account, or cash dividends, as your book likes to call it, is the D in aid reveille. This is that dividend account. This is the dividend account that's going to appear in the statement of retained earnings. This is the dividend account that we're going to close when we do closing entries like we learned in chapter 4. So this is that dividend account. It has a normal debit balance. It's going to record all the dividends that we declared this year, and then we'll close it out at the end of the year. So we've created this liability here that shows, hey, I have this debt. Now, on May 15th, which in our example is the date of record, we do not make a journal entry. That's a date that we're going to make a list of everybody who owns the stock and how many shares they own and what their address is, but that's not actually a record that we record in the journal entry. So no journal entry on the date of record. Now, on the date of payment, though, this is when we're going to send off the checks and reduce the liability. So now we'll debit that liability account, dividends payable, and we'll credit cash. So then, as I mentioned, remember at the end of the year, December 31st, when we're doing our closing entries, we close the dividends account to retained earnings. So since the dividends account has a normal debit balance, remember we credit it to close it, and then we debit retained earnings. Since dividends decrease retained earnings, by debiting retained earnings, we are reducing the retained earnings account because remember it has a normal credit balance. So this entry we learned learned back in Chapter 4. This is not a new entry to us. Now, let's look at dividends if we have preferred stock. So we talked about, remember that dividend rate, that 6%, determines the amount of dividend that the preferred stockholders will receive. So since the par value on the preferred stock was $50, for every share of preferred stock, the preferred stockholders will receive $3 of dividends. So here we're told Greg's Games has 1,000 shares of 6% $50 par value stock. The dividend would be the outstanding shares times the par value times the dividend rate, or $3 a share times 1,000, which is where we get $3,000. So the preferred shareholders will get $3,000 first, and then everything else will be divided among the common shareholders.